Guys, I am going to discuss that how to prepare the operating statement based on the variance. The question of HNDA 4th year 2nd semester 2018 past paper, question number 4. The question is, second part questions. A company manufactures one product and the end product is sold as soon as possible it produces. There are no opening or closing inventory and working in process is negligible. The company operates a standard costing system at analysis of variance is made every month. The standard cost card for the product X is as follows. The cost card means the details for one unit. So standard cost card means budgeted details for one unit. So budgeted unit for one unit direct material is given and direct wages given, variable overheads given, fixed overhead given, total standard cost given per unit, standard profit per unit is given, sales standard selling price is given. The budgeted output for the January was 5,100 unit. Actual results for the January were as follows. Production of 4,850 units was sold for 95,600. Material consumed in production amount 2,300 kilogram at the total cost of 9,800. Labor hours paid for the amount to 8,500 hours at the cost of 16,800. Actual operating hours amount is 8,000 hours. Variable overhead amount 2,600. Fixed overhead amount to be 42,300. So there's a different actual operating hours 8,000 and actual paid hours for 8,500. So there is a 500 hours is a ideal time. What is the meaning of ideal time? In every production organizations or any organizations, the employed work for 8 hours. For example, for one day, if working for 8 hours, they are not working 8 hours fully focused on production. There should be some hours for lunch covering or tea break or machine repairment. That's why some of hours is not efficiency for the production. That is the 500 hours in here. That is ideal time. So we need to calculate all the variance and prepare the operating statement for January. So we need to calculate all the variance which is want to calculate the or prepare the operating statement. So we need to prepare these variance to prepare the operating statement. First, material variance. Under the material variance, we need to calculate two variance: material price variance and material usage variance. And under the labor variance, we need to calculate three variance. On first one, labor rate variance, second one, labor efficiency variance, third one, ideal time variance. Okay, then under the variable overheads variance, we need to calculate two variance: variable overhead expenditure variance, variable overhead efficiency variance. Under the fixed overhead variance, we need to calculate two variance: fixed overhead expenditure variance, fixed overhead volume variance. The sales variance, we need to calculate two variance: sales price variance, this is based on the price. Second one, sales margin variance, margin volume variance, this is based on the profit. So these variants are enough to prepare the operating statement. So let's calculate. I have given the two pattern of equations, both the same meaning of equations, so you can choose which is easy for you. So first, material price variance, the first equation AQ into SP minus AQ into AP. The second equations AQ within the bracket SP minus AP. So what is the meaning of AQ? Actual quantity meaning usage or consume material for actual production. And SP meaning standard price per unit of material. And AP meaning actual price per unit of material. So let's calculate. AQ actual quantity for the actual production of material is 2300 kilogram. So 2300 kilogram is the actual quantity into standard price. Standard price meaning the standard or budgeted price per unit of material, that is 4 rupees, minus AQ into AP. AQ into AP meaning the total cost, actual cost they given in 9800. This is a AQ into AP. So we can identify the AP separately, that is 9800 divided by 2300. So 4.260869565217391 is the AP. So instead of using the AP, we can put the full amount 9800 as a AP into AQ. 9800. So we can multiply 9200 minus 9800. So we need to indicate is a favorable or adverse. So how can I identify the favorable or adverse? The budgeted amount is less than actual amount is a adverse. Budgeted amount more than actual amount is a favorable. Here 9200 is a budgeted amount because we compare the price. So SP and AP. SP is standard price, AP in actual price. So 9200 is the budgeted amount and 9800 is the actual amount. So we estimate 9200 is expense, but we paid or we spent 9800. So 6000 is more than budgeted, so it's a adverse. So second variance, material usage variance. The equation is SQ into SP minus AQ into SP, or SP within bracket SQ minus AQ. So we need to compare the usage of budgeted and actual. So what is the meaning of SQ? SQ meaning budgeted material for actual production. SQ meaning budgeted material for actual production. And SP meaning already said the budgeted 1 unit of material cost. AQ already said the actual material usage for actual production. SP is the same. So SQ actual production as per the question paper 4850. 4850 into material required for 1 unit is standard is 0.5 kilogram. 0.5 kilogram. So 0.5 kilogram. This is a SQ. 4850 into 0.5 is a SQ. And SP standard price per material is 4 rupees. So SP is 4 rupees. minus AQ into SP. AQ 4000, sorry, 2300 into SP 4 rupees. So we can get the summary by multiply. $9,700 minus 9,200. Here we need to compare the quantity. So SQ, so this side is a budgeted, AQ, this side is a actual. So we budgeted the expenses, material usage expenses 9,700. What we spent 9,200. So there's a 500 is a favorable because we spent less than 500 than budgeted. So 500 is the favorable. Okay. Then third variance, labor rate variance. Okay. In here AH, actual hours. Actual hours meaning actual hours used for actual production. SR. SR meaning standard rate per hours. Minus AH into AR. AR meaning actual hours rate. Actual hours rate. So as per the question paper, we can calculate AH, actual hours. Actual hours, labor paid for 8,500. This is the actual hours per labor rate variance. 8,500 into SR. SR meaning standard rate per hours. Standard rate per hours 2 rupees. So SR 2 rupees minus AH into AR, that is a total cost of labor. The total cost of labor 16,800. So AH into AR 16,800. So 17,000 minus 16,800. So there is a 200 is a favorable. Why favorable? We compare the standard rate and actual rate. This side standard rate and this side actual rate. So the standard rate we budgeted 17,000, but we spent 16,800. So 200 is less than the budgeted. So that is a favorable. And next one, labor efficiency variance. The labor efficiency variance equation is SH into SR minus AH into SR. That is a equation. SH into SR minus AH into SR. Or SH or labor rate variance equal to SR within bracket SH minus AH. Both equations are same. So which is easy for you, you can use the equation. So first SH. What is the meaning of SH? SH meaning the standard hours for actual production. Standard hours for actual production. So SH, as per the question paper, standard hours 2 hours. Standard hours 2 hours. For actual production 4,850. So 4,850 into 2 hours. This is a SH. And is into SR. SR, what is SR? 2 rupees. 2 rupees. minus AH actual hours. In here we are calculating the efficiency variance, so we need to use the 8000 as a actual hours, because 500 hours are not efficient, so we can't use the 8500. So we should use 8000 as a actual hours for efficiency variance, not rate variance. Rate variance we use 8500. So for efficiency variance we should use 8000 hours as actual hours, because 500 hours is not efficiency, this is a ideal hours. So 8000 hours actual hours into standard rate is 2 rupees. So 19,400 minus 16,000. So here 3,400. 3,400 is favorable. Why favorable? We compare the hours, standard hours and actual hours. This side standard information, this side actual information. So standard expense is 19,400, but we spent 16,000 actually. So 3,400 is favorable. Next variance, we need to calculate ideal time variance. Ideal time variance equal to ideal time into standard rate. Ideal time into standard rate. Ideal time as per the question paper, 8,500 minus 8,000 is a 500 is ideal time. So 500 into 2 rupees standard rate. So 1000 is adverse. In any time, ideal time should be as a adverse. It's not a favorable. Okay, this is a adverse. And next we need to calculate the variable overhead expenditure variance. So variable expenditure variance, in here the same equation, AH into SR minus AH into AR, or AH within bracket SR minus AR. Here actual hours AH, that means actual hours per productions. So in question paper they didn't mention the actual hours, so we need to take the labor hours as a variable overhead actual hours. So what is the labor hours? Operating hours, because we need to use the variable overhead when operating the production. So 8 hours is the operating hours, so this is a variable overhead hours. So 8 hours is actual hours, 8,000 hours into standard rate. Standard rate per variable overhead 0.3. So 0.383 is standard hours minus AH into AR, that is the total cost of variable overhead. So total cost of variable overhead 2,600. 2,600. So 2,400 minus 2,600. Here we compare the rate. So standard rate into actual rate. Here standard, this side is a standard hours information, this side actual information. So as per the standard we spent 2,400, but as per the actual information we spent 2,600. So there's a 200 is adverse. variance, variable overhead efficiency variance. The equation is SH into SR minus AH into SR. What is the meaning of SH? As I said earlier, the actual standard variable overhead hours for actual production. So SH actual production is 4850 and standard variable cost variable hours is 2 hours. So 4850 into 2, this is a SH, and SR is 0.3 minus AH 8000 into SR 0.3. So 2910 minus 2400. So there's a different 510. This is a paper hour because we compare the rate. We compare the hours. So standard hours and actual hours. So in this side we use standard information, this side we use actual information. So 2910 is budgeted information, 2400 is actual information. So we spent less than 510, so that is the paper hour. Next, fixed overhead expenditure variance. That's the equation is budgeted overhead minus actual overhead. So in the question paper, the budgeted overhead is fixed overhead 2 hours at the rupees of 370 and total budgeted unit 5100 unit. So total budgeted overheads into 2 hours into 3.70. So 37,740 is the budgeted overhead. 37,740 minus actual overhead 42,300. 42,300. So here 4560 is adverse. So next variance, fixed overhead volume variance. So that is the equation is recoverable overhead minus budgeted overhead. So we need to calculate the recoverable overhead. The equation is budgeted out overhead divided by budgeted unit into actual unit. So budgeted overhead 37,740 and divided by 5,100. This is a budgeted unit. 5,100 budgeted unit into actual unit 4,850. This is a actual unit. So answer is 37,740 divided by 5,100 into 4,850. So 35,890. 35,890 is by recoverable overheads. So 35,890 minus budgeted overhead 37,740. So here 1,850 is adverse. Next variance, sales price variance. The equation is AQ into SP minus AQ into AP. The AQ mean actual quantity of selling into SP meaning standard price, and AQ into AP meaning actual quantity of selling into actual selling price. So here actual quantity 4,850 into standard price of selling as per the question paper is 20. So 20 minus AQ into AP, that's meaning total sales value. They given 95,600. So 95,600. So 97,000 minus 95,600. Here we compare the sales price and actual price. So this is a standard, this is actual. So here standard 97,000, but we sales 95,600. So here 1,400 is adverse because sales is more than budget is favorable. Sales is less than budget is adverse. So 1,400 is adverse. Next budget, sales margin volume variance. The equation is SQ into SP minus AQ into SP. Here SQ is standard quantity of selling into SP is standard profit. It's not a price because it's a margin variance, sales margin variance. So here SP is standard profit. So here SQ 5,100 into SP standard profit. Standard profit here 6 rupees. So standard profit 6 minus AQ 4,850 into SP 6. So here 1,500 is adverse. We found all the variance which is need to prepare the operating statement. So we can prepare the operating statement. Details, adverse and favorable, and amount. First one, budgeted profit is 5,100 into 6. That is a budgeted profit because budgeted unit is 5,100 and budgeted profit is 6 rupees per unit. So 30,600. Then we can add one by one the variable variance. First, sales price variance. Sales price variance is, as per the calculation, 1400 adverse. So 1400 adverse. Next one, sales margin volume variance as per the calculation 1500 adverse. And material price variance as per the calculation, the material price variance 600 adverse. Next one, material usage variance as per the calculation 500 favorable. 500 favorable. And next, labor rate variance. Labor rate variance 200 favorable. 200 favorable. And labor efficiency variance 3400 favorable. 3400 favorable. And next, ideal time variance. Ideal time variance 1000 adverse. Ideal time variance 1000 adverse. And variable overhead expenditure variance. Variable overhead expenditure variance 200 adverse. And variable overhead efficiency variance 510 favorable. 510 favorable. Fixed overhead expenditure variance. 4560 adverse. 4560 adverse. And fixed overhead volume variance. 1850 adverse. 1850. So this is the operating statement. So you can sum of adverse figure as well as favorable figure. Okay. So total of adverse 11,110 and total of favorable 4,610. So we need to deduct 6,500 from the profit. So 30,600 minus 6,500. So 24,100 is the actual profit for actual sales. So this is the operating statement. So to do this operating statement, we need to calculate this variance to complete operating statement. So this video more helpful for HNDA students. So if you have any doubt, please comment below the video. Thank you.